Good morning and welcome to the ADS Securities Markets Update. Today we'll start again with an overview or a look at the latest economic figures that were released yesterday from the US, which led to some sort of confusion on the markets across the board. Yesterday's figures proves that the US economy also is slowing down further, and the retail sales came in contrary to the market estimates. The advanced retail sales fell sharply by 0.9% in December, while the estimates were to rise by 0.2%. Furthermore, November's reading has been revised down even lower towards 0.4% instead of the initial reading of 0.7%, and this is the biggest monthly decline since January of 2014. The core retail sales also came in even worse, declining by a full 1% in December, despite the fact that the estimate or it had been anticipated to rise by 0.1%. Moreover, the November's reading has been revised down even lower towards 0.1 instead of 0.5%, and this is the biggest decline since 2009. The month-over-month import prices also fell sharply by 2.5% in December, while the estimates were to decline by only 2.4%. And furthermore, the November's reading also has been revised even lower toward minus 1.8 instead of minus 1.5% in December. And also the December decline is the biggest monthly decline since 2009. The year-over-year import prices also came in worse than expected, declining by minus 5.5% in December, comparing to a decline of 3%, which is also revised from minus 2.3%. While the estimates also were to decline by 5.2% only, and this is also the biggest year-over-year decline since 2009. Finally, the business inventories was the only figure which came in as expected, rising by 0.2% in December, comparing to the same rate or the same rising rates in November. However, the sales fell for the second month in a row. The US dollar fell across the board following these figures, as the outlook seems to be weakening recently, which eases the speculation for a rate hike by the Federal Reserve in the first half of this year. And there were also some sort of confusion in the US equities yesterday, with its choppy moves and a lower liquidity, and this confusion is likely to continue until the inflation figures are released later tomorrow. As for today, the Asian session, there were a collection of economic releases from Japan, Australia and China, which had a notable impact on the markets. Beginning with Japan, the missionary order increased way less than expected, rising by 1.3% in November after declining by 6.4% in October, while the estimates were to rise only by 4.8%. Moreover, the PPI in Japan eased back sharply toward 1.9% in December, down from 2.6% in November, while the estimates also were to decline toward 2.2% only, and this is the sixth monthly decline in a row and the lowest reading since March of 2014. In Australia, the jobs report came in much better than expected today. The economy added more than 37.4 thousand new jobs in December, comparing to 45,000 in new jobs in November, while the estimates were to add around 5.3 thousand in new jobs only. And this is the third monthly job creation in a row not seen since the beginning of last year of 2014. And most of these jobs were created in December were full-time jobs, while the part-time jobs also only fell by 4.1 thousand in new jobs. The unemployment rate also falls back towards 6.1%, down from 6.2%, while the estimates were to rise slightly towards 6.3%. And furthermore, and most importantly, the participation rate advanced again to 64.7%, which is the highest since July of last year and the third monthly increase in a row. Finally, in China, the new loans unexpectedly fell back towards 697 billion yuan in December, down from 853 billion in November, while it had been anticipated to rise toward 885 billion. As for the European session today, there is only one economic release from the Eurozone, which is likely to have a slight or even muted impact on the market across the session. The Eurozone trade balance surplus is expected to rise again toward 21.3 billion euros in November, up from 19.4 billion euros in October, which would be the highest on a record. Going forward to the US session today, we will be watching, or we will be focusing on another collection of economic releases across today, which is likely to have the major impact on the market across the board, beginning with the PPI, which is expected to decline by 0.3%, comparing to a decline of 0.2%, which would be also the second monthly decline in a row not seen since 2013. However, the core PPI is expected to rise by 0.2%, comparing to no growth during the same period. The weekly initial jobs claims today is expected to rise again to 299,000 last week, up from 294,000 the week before, which would be also the highest reading since 7 weeks. Furthermore, the Empire State Manufacturing Index may rise again toward 5.3 in January, comparing or up from minus 3.6 in December. And finally, and most importantly, the Philadelphia Fed Manufacturing Index may decline further for the second month in a row toward a 20.3 in January, down from a 24.5 in December. These are the economical leaders for today, and this is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube, to get the latest economical leaders, reports, and analysis. Thank you for watching.